Hi guys, my name is Ismail, and in this video we are going to talk about trading plan. If you are not following a trading plan, then you are not trading, you are gambling. So in this video, I'm going to show you how to write a proper trading plan that actually keeps you disciplined, that actually keeps your discipline in shape. And to begin with, I would like to briefly talk about what exactly is trading plan. So trading plan is simply a written system. See, trading plan is not something that you memorize or something that you have it in your head. It's something that is written, and it's something that you must follow each and every day of your trade. So that tells you exactly what to do before you place a trade, during a trade, and after every trade, so that you do not rely on emotions or guesses or impulsive tradings. So that is what trading plan actually means. I strongly believe you already have um at least a brief definition of what exactly trading plan. So we will be going into what exactly is in a trading plan, what a trading plan actually consists for it to be a proper trading plan. We will be going over them very soon. And number one of that thing is market focus. You may be wondering, like, what is market focus? Don't worry, don't rush. I'm going to explain each and everything that's supposed to be in your trading plan in order for you to execute your trade, to manage your trade, and to exit your trade properly. So now let's talk about market focus. So when we say market focus is simply defining the pairs or instruments that you trade. So one of the mistake that beginner does is that they try to trade every pairs. They try to trade every instrument, and that is not the right way to actually trade. So professional traders only pick few pairs. They pick a particular pair that actually goes with their edge, that their edge that they have a proven um edge on. What I'm trying to say is that for you to trade a particular pair, you really need to gather, like, yeah, to gather in data on that particular pair. You really need to gather data on the pair, and that data actually shows that your edge or your strategy actually works on that pair. Your strategy or your edge actually work on that pair in a long run. You understand? I'm not saying that you are not going to take losses on it, but for you to pick a particular pair, you really need to study that pair. You really need to backtest that pair. You really need to collect a good data on that pair before you pick a pair to trade. You don't just trade every pair. These are some of the mistakes that beginners actually make. I personally, I am not excluded. I made the same mistake when I started. I traded every pair to the degree that I even traded the USD South African rands. You know, you know how ugly that pair is. If you think I'm lying, just go and try that pair. I think I even traded the USD NGN one time like that because I don't really know anything about trading plan. So this is one of the most important part of your trading plan. You need to actually look for pairs that actually works with your edge. You understand? So that is that. And for example, if you take a look at all these big guys, like for example Tony Ike, Tony Ike actually trade bullish pairs mostly, like gold, GBP, JPY, USD, JPY, BTC. These are the pairs that Tony Ike actually trade, and he tends to trade more volatile pairs compared to pairs that are not volatile. When I say volatile, it simply means pairs that are actually fast. You understand? Pairs or instruments that are very, very fast. He doesn't trade medicure pairs that are not fast. Tony Ike doesn't trade them. This is to show you that that is the kind of pair he actually studied, the kind of pair he likes to his edge or his system works on. So that is it. This one is very, very important. Hope you are taking it. Now let us move on to the second part, or the second thing that is very, very compulsory. So second thing that is necessary for you to include in your trading plan: setup definition. You may be asking or maybe wondering, what is setup definition? You don't need to worry about it. I'm going to explain it in a way that you will understand. Even a small picking will understand. So setup definition. You must clearly know what you want the market to present to you before taking a trade, not just random clicking of button. So setup definition, I think is another word for your strategy, or another word for your edge, another word for what you are looking for in the market. So if that thing doesn't present itself to you, you don't take a trade. And you must clearly state it in your trading plan that, okay, setup definition. This is what I want to see in the market. You must clearly lay them down, the rules. It may be a break of structure, inducement, then your POI, your point of interest. If all these things doesn't happen, you are not going to take a trade. You understand? So these are some of the things you really need to take note in your trading plan. Now let's move on to entry rules. Entry rules, as the name implies, though I'm going to explain it better, it simply means you must have a clear entry rules. Are you an aggressive trader or a conservative trader? You must clearly define the trader for your entry and exit. You understand? So what this really means is this: entry rules. What kind of trader are you? Are you an aggressive trader? When I say aggressive, did you just set limit and market get in your limit and execute, or you are a trader that wait for confirmation and enter using market execution? There's market execution and limit order execution. So if you are a conservative trader, simply means you execute using market execution when you see your confirmation. But as an aggressive trader, you execute as an aggressive you execute using limit order. You don't wait for confirmation. You understand? So you need to lay all these things, know what works for you and know what doesn't work for you. So you need to try all these things as a beginner coming into the market. You understand? Now let's move on to the next stage, the next part. This particular one is very, very important, is one of the backbone of a profitable traders. If you are a forex trader and you don't know anything about risk management, then you are not a trader yet. You really need to manage your risk in order for you to be profitable in this system. Now, what is risk management? Risk management, you must clearly state how much to risk per trade and state clearly how many trades you are going to take per day. You understand? So when we are talking about risk management, is this: you really need to clearly state in your trading plan, and this your trading plan is more like a rule that you are not going to break. You understand? Because if you break this rule, you must make sure that there is something being put aside to punish you when you break a particular rule. You understand? So so risk management, you really need to define how much to risk per trade, and like maybe 1% of your account, 2%, 3%. But it is advisable for professionally to always risk 1% of your capital, 1% of your total capital. So, and you really need to define how many trade you are going to take per day. Maybe you take a trade and you hit a loss. Are you allowed to take another trade for that day again, or you wait till your next or the next day. This is what your trading rule is all about, and this is what risk management is all about. And if you are able to stick to your rules, stick to your risk management, a proper risk management, definitely you will be profitable in a long run. Now, let's talk about take profit logic. So, take profit logic, this one is very simple. It's more like defining your RR, your risk to reward. So, you must define how you are going to take profit, especially your RR. You really need to clearly state your RR, either fixed RR or structural based RR. You can get this from your backdated result auditor. Now, let me actually explain this because some newbies might actually get confused with the words I'm using. When I say structural base simply means you have a certain target and you are anticipating a market or price to actually reach that place. That is what we call structural base. And fixed RR simply means you just place your trade and maybe you only risk 1% to make 2%. That is what we call 1 to 2 risk to reward or 1 to 2 RR. You understand? But when you are working structurally, you actually use the structure of the market to target your RR. So this one is more deeper when it comes to structural RR. So, but some traders actually use fixed RR. For example, I personally use fixed RR. I use 1 to 2 risk to reward to take my trade. So that is it for take profit logic. Another thing, it's very, very important for you to include this in your trading plan. You really need to clearly state either fixed RR or structural based RR. And you can actually get this from your backtested result, when you were doing your back testing. So you'll be able to know if you have to use structural based RR or fixed RR. Now let us move to time rules. So time rules, this particular one is not really to me. I don't use time rules, but other traders might use, especially full day traders. So this one is simply means you really need to clearly state when you are going to trade. Though there's one strategy that I normally use. It is called quarter point theory. That one is time based. So I only take a trade during the London session, and anything outside London session, no. I don't take a trade using that system again. So I only take that trade once in a day using that edge. But there are other strategies which I can actually take a trade depend on when my edge present itself. So this is what we call time rules. So is your system time rule or not? So you really need to clearly state it in your trading plan. You understand? So this time rule simply means you only trade during a particular session and you don't take trade outside a session. Now let's talk about the next one, which is psychology rules. Psychology, this one it will take you time for you to master your psychology because it takes me some time before, if not when I started, whenever I place a trade, that is how I'll be washing, I'll be shaking. You understand that kind of thing? I get excited when I see blues and I feel a kind of down when I see red. You understand? So psychology rule, you must clearly state your rules about revenge trading and over trading. So these are some of the two things that you really need to control when it comes to the rule of your psychology. So when I say revenge trading, when you take a loss or when you take a win, do you just walk out of the chart or you just try your luck even when your edge doesn't even present itself to you? Or do you over trade, like you just be clicking buttons, like you just see, you just think, oh, market will be going up from here, you click a button, market will be going down, you click a button. These are some of the things you really need to clearly state. And the best way to do this is that you need to clearly to state that okay, no revenge trade and there's no over trading. That is when you state how many trade you are going to be taking in a day. I think we've already talked about that, which is in your risk management, and no revenge trading. And you really need to stick to your rules, like if market doesn't do this, I don't do this, I don't execute. And the last one is the review process. If you are a beginner, if you are starting out, you really need to take this one very serious. So this is review process, and review process actually is all about journal. Understand? So if you are starting out, you really need to journal your trade. So you really need to journal like this. Okay, what exactly did you see in the market before you execute this trade? So this trade that you actually took, what is the result? Is it a win or a loss? You understand? These are some of the things. You can do this for like 1 month, 2 months, or 3 months. Then from your journal, it will now, journaling will do for you is that thing that you've written down already, when you see that same setup that either end up in a loss or a win, after that thing is being written down, then you can easily, your brain can easily go back to that thing, that oh, this is the kind of trade I took and I took a loss, so or the kind of trade I took that ended up in a win. You understand that kind of thing? So this journaling will make it easy for you to master the market. It will be easy for you to master and adapt to the market. That is one of the advantage of journal. You understand? So that is it for this video, guys. Seriously, risk management is very important. Sorry, trading plan is very important. You really need to take it very serious. So guys, we've come to the end of the video. Actually, if you have any question concerning trading plan or any other thing about trading, forex trading, my DM is open. I'm going to drop my X account link in the description box, so that if you have any question, you can actually DM me. I offer my service for free. You can ask any question, and if you derive any value, don't forget to actually like this video and share this video with your friends so that they can benefit from it too. So that is it, guys. Bye bye, and have a great day ahead.